What's going on, everybody? Welcome to a capital hungry, higher time frame and macro analysis webinar. It is currently Sunday, November 27th. We are approaching the end of the business month of November and even the end of the fiscal year in another month, with 2022 coming to a close. Time has flown by ever since the start of the pandemic, and we have been very involved in the markets over the course of the last 2.5 years, as we've had so many various fundamental catalysts impacting order flow in asset classes, trading instruments that we trade, and even impacting our day-to-day life, from our cost of goods to our social interactions to gas prices, grocery prices, real estate prices, and how we have been moving forward from the lockdown periods as well, which has been very, very interesting. But anyways, we're going to be starting out this higher time frame analysis by looking at the dollar. The main reason for this is over the course of the pandemic, which has primarily been and post-pandemic era, which has primarily been everything highlighted within this yellow box, dollar individually as a trading instrument and of course as the currency of the United States of America has been giving us a lot of information to play to our advantage. Whether it was the first part of the pandemic when we had the easy money, low interest rates, and pumping of the markets and increasing of money supply, which led to dollar weakness, or whether it's been since we've been playing the macro information advantage of the Federal Reserve rate hike cycle, dollar has been playing a huge part in our understanding of fundamentals, intermarket correlations, and understanding market psychology and market sentiment. Now, we're not going to go through the whole spiel again and the whole timeline of what happened through the pandemic and all of that, as we've done that dozens and dozens of times before. What we're going to be talking about is dollar from a macro perspective and what we can see to close off this month and even into the month of December as we go into the new fiscal year of 2023. Now, ever since we had the Federal Reserve start to give us signals towards tapering and stopping of stimulus, we have been playing what we have coined as dollar domination. Federal Reserve doing active rate hike cycles as countries and economies around the world are in recessions. Primary focus of front-loading rate hikes to combat a high-risk inflation. And that sentiment held a lot of weight ever since they started giving signals of starting tapering, when they were going to do tapering, rate hikes, and continuing the rate hikes as well, right? From a historical perspective, this has broken us above price points that we have not seen dollar trade above since around the year 2000 and 2001 here. And from a psychology perspective, we have become very accustomed over the course of a year and a half playing this impulsive dollar domination. But what we have to look at is history and other bullish runs on dollar, which are very, very common to see very similar patterns in movements of order flow. Now, as we've been playing this dollar domination and we peaked around these price points highlighted here around 114, coming towards the end of the fiscal year, we've also had some fundamental catalysts supporting some stock market upside, which has been primarily induced by Fed pivot prayers. The last FOMC sentiment getting faded out, and then not holding enough weight to continue the dollar domination as we had higher US unemployment rate and lower improved CPI. Both catalysts that would lead to weakness in the dollar and more demand in risk assets. What we also understand from a human psychology perspective, market psychology perspective, and real world implications is that it's a lot easier for the stock market and risk assets such as gold or oil to be bullish than it is to be bearish. Whenever gold is bearish for an extended period of time, or oil is bearish, or the stock market is bearish, this is primarily due to a crisis period that's induced or by some heavy changes in central bank monetary policy, like we saw with the Federal Reserve's historical aggressive rate hike cycle. But as this information has been priced in, we have been seeing a much more aggressive, deeper pullback phase here that is still in correlation in terms of dollar still being fundamentally and technically bullish on the higher time frames and still holding above key price points of interest while breaking out of bearish structure here that we've seen from a historical perspective. And when we look at other historical bull runs on on dollar here, whether we're looking at here from the 1980s, which was a monstrous bull run, or whether we're looking at here from 1995 to the 2000s, you can see that it's very, very common to get correlated pullback phases. Now, we have to understand something. From a trading perspective and from an investing perspective, playing this dollar domination has been very black and white. Feds are continuing their rate hikes. We have a shift in the market sentiment on a macro perspective. We have dollar strength as Feds are increasing rates, limiting supply, ending the free money era, doing the tapering and stopping of stimulus. And during this period of time, real estate's been a lot more bearish. Stock market was bearish during this period of time. Gold bearish, oil bearish as well, right? But that increased upside volatility on the dollar also has a lot of negative, detrimental impacts on emerging countries, other currency values, and other asset classes within the financial market as a whole, due to the position that the dollar holds on a global scale as your world reserve currency and as your business currency, with majority of international business and trade still being denominated in US dollars, right? So besides even having just the bad economic data in terms of an increased unemployment rate or having improved inflation, which feeds into pivot prayers, even prior to that, we were seeing actions by other countries to try to limit the upside volatility on the dollar, slow down dollar domination, whether it was something like currency interventions of Japan buying more of the yen to prop up the yen against the dollar, whether it was a currency intervention in terms of the events we saw from China, with China actively selling off US dollars, whether it was something like the UK decision with the Bank of England doing a bond buying program amidst a rate hike cycle to help prop up the value of their equity markets and their economy and so forth amidst dollar domination. We've seen various interventions by other countries trying to slow down the upside volatility on the dollar, right? And we've also been very accustomed to dollar domination as we've just had consecutive months and months of upside. It's very similar to any of these other dollar runs where you can see even from here to here, from this low to this high area, and from here to here, there was literally us being on the 3-month time frame right now, quarterly time frame. There was no quarterly 3-month period showing any signs of slowdown during that bullish run until we had a larger correction here, a larger correction here, and the correction we're starting to see take place here. What I'm trying to say is, even though on the intraday time frames and in the short term, the dollar weakness looks very aggressive, when you backtest and understand the behavior of the dollar on the higher time frames and how it moves when it's extremely bullish, this is still very, very common. I could still easily see, even into the new year, dollar coming to retest this demand zone at around 101, 100 flat, and still being very bullish on the higher time frames. Does that mean we're just going to start to jump back into dollar buys right now, willy-nilly, without any fundamental or technical confirmations? No. With Christmas rallies coming up, a lot of the Fed rate hike cycle sentiment priced in, that one improved inflation report feeding into Fed pivot prayers, risk assets still having demand and strength, we could easily still see deeper pullback phases on the dollar, where it looks like sellers are going to be coming into play, but it's just an extended pullback phase in correlation and in relation to the aggressive upside that we've seen over the last year and a half. Now, in the near term, we do have Jerome Powell's speech. In December, we will have another inflation reading in labor market data and the December FOMC. Those will be the catalysts as we take it day by day and week by week, whether we see dollar domination come into play prior to the new year, right? But remember, it takes a lot more for the dollar to be bullish than it does to be bearish. It takes a lot more for the stock market to be bearish than it does to be bullish. And understanding the behavior of historical runs, we're also going to dive into that, understanding order flow and technicals as well. So let's zoom out here and look at previous dollar movements. We can see it's very common to get extended consolidation phases that don't break the overall structure prior to having some extended dollar bullish runs. And just on the chart, we can see here, we've seen 2 or 3, with now being pretty much the third extended dollar bullish rally. Here in the 1980s, global economic crisis, here going into the 2000s, and even here post 2008 GFC, that upside on the dollar from a technical perspective of structure is still being very much maintained, right? But you can even see similar chain of events here, right? Now, you can see it's extremely common that when you have these historical periods throughout the various time, throughout the points of interest during this timeline here, right? That when dollar's pushing bullish, it pushes bullish in a very aggressive fashion. What do I mean by that? Well, right now we're on the quarterly chart. We're on the 3-month chart. You can see these bullish rallies see extended upsides for consecutive months over months and even a year before seeing any type of correction take place. Here, 3, 6, 9, almost a year of straight bullish rally on a macro perspective before finally having a deeper corrective play where you cancel out that upside price action and show a strong bearish candle that follows, right? Here. And I'm not even going to look at the lower part here. 3, 6, 9, 12, 15 months of bullish upside before it looks like you're going to have dollar sellers come into play, extended weakness for a period of almost 9 months there before still continuing bullish. Here, 3, 6, 9, 12 months minus some of this consolidation here before you finally had a correction where it looks like dollar sellers were going to come back into the scene before continuing bullish, and then this being the COVID area here, right? Now, when we're looking at this bullish rally, three, 6, 9, 12, 15 months of straight dollar domination and bullish upside. Now, it's not just understanding that this behavior and movement on the dollar is still respecting historical movement of previous crisis and eras of dollar domination and bulls. It's also understanding that from a psychology perspective, we've been very accustomed to playing dollar domination. Pullback, dollar buys. Breakout, dollar buys. The correlation on other trading instruments following the active Federal Reserve rate hike cycle, right? And it's also very common that whenever you get these aggressive pullback plays on the dollar, whether it lasts a month or 2 months, that it can engulf previous bullish monthly candles. It can show very hard signs of rejection. It can look like sellers are really coming back into play, with potential here that we could still see dollar come to 100 and still be very bullish on the higher time frames. Like I said, does that mean we're going to start to just anticipate and jump in dollar buys for no reason? Of course not. But what it means is that from a psychology perspective and from an intraday or scalping perspective, we have a higher probability that we are in one of these aggressive pullback phases on the dollar, where we still want to play some short-term dollar weakness, dollar bears, and the intermarket correlations of the Federal Reserve's rate hike cycle being priced in. If Jerome Powell doesn't bring any new information or aggressive hawks to the table, if the December CPI report is still relatively neutral and showing signs of improvement, if the December FOMC is still relatively neutral, and we have the Christmas rally in equities bringing a lot of optimism, keeping consumer morale up, keeping investment activity up, keeping overall economic activity up, then there's still a lot of room for dollar to have deeper corrections, to come and retest those previous broken highs, still maintaining this overall sequence of events of bulls and having a correlated corrective phase, right? As long as into the new year of 2023, CPI is still high, the Feds are still continuing their rate hikes, US economy is still in a very similar situation of what it is in now, we can easily still have these downside moves or pullbacks on the dollar, very similar to this aggressive pullback here, these aggressive pullbacks here, still end up getting faded out, continuing dollar domination. When we're looking at dollar structure, even prior to comparing it to any of these dollar bullish runs, which is still very much in correlation of how it behaves, even when we're zooming in a bit further, we can still see bullish market structure, accumulation of buy-side liquidity here, accumulation of buy-side liquidity here. We had 15 plus months of just straight upside on the dollar. Now, as we're approaching the end of the fiscal year related to market timing, and understand the narrative of the 1%ers and people in control to keep consumer morale, consumer spending, and investment activity high through the holiday season and into the end of the year, seeing this pullback phase induced by Fed pivot prayers of an improved inflation report and high unemployment rate reading is not out of the ordinary at all, right? And having us come to even revisit deeper into 102, 101 handle if we don't get any fundamental confirms of dollar domination into the December period is also still very understandable and very high probability. Understanding market psychology, market waves, real world implications of dollar domination, and the market timing of coming into the North American holiday season and end of the fiscal year. It would still be maintaining overall bullish structure. It would still not be correcting this entire upside move. We would still be holding this previous zone broken, becoming into a buyer's demand zone. And in terms of historical rallies on the dollar previously seen in history, it would not be out of the ordinary to any of these other aggressive pullback phases we have seen after extended continued upside dollar movement, right? So what I'm trying to summarize here is the main points of interest that we're going to be looking at to close off November and into December is going to be one, Jerome Powell's speech this week coming towards the end of the month. Two, the December CPI report and labor market reporting. And three, the December FOMC. If Jerome Powell doesn't bring aggressive hawks to the table and shut down pivot prayers, if the December CPI is still showing some minor signs of improvement or neutral from the previous report, if the labor market data is still showing signs of weakening, and if the next FOMC is still neutral to dovish, right, we can still have dollar in this higher time frame bearish pullback phase, which again setting up order flow into 2023. Can easily come retest 102, 101, and still be bullish going up to 120s, right? We would really need a full Fed pivot, continued month-over-month improved inflation reports, and extremely weak recession data to get a complete shift in this sentiment here. But just like if we were trading in the 1980 period here or 1995, you can see through the various waves, that dollar upside rally, give or take some of these aggressive correlated pullback phases, lasted almost 4 to 5 years, right? 1995 lows all the way to almost 2002, another 5-year bullish rally on dollar with very large correlated pullback phases. From 2022 to 2027, we could still have this extended bullish rally going to the upside with the shift in the macro market cycle, the shift in central banking monetary policy from the easy money era to keeping rates up and bringing inflation down and so forth, right? And if we do have that take place, don't be surprised if we do see more aggressive pullback phases in the overall bullish rally, right? So from a macro perspective, as long as dollar is still holding above 102 area, 103, as long as it's not breaking this bullish market structure forming here as well, as long as we're not fully correcting the upside rally that we've seen, in terms of coming towards the end of the fiscal year, in terms of understanding market psychology and market timing, seeing this more aggressive pullback phase is not out of the ordinary by any means at all. Okay? Dollar domination on a macro scale has not been stopped yet. We're just having a correlated pullback and correction phase, which also feeds into stock market greed with less demand in dollar and more demand in risk assets, and still having it related to the upside and in relation to market structure, right? Now, when we're looking at the monthly time frame, you can see this even more zoomed in. For example, look at this bullish rally. Nice order block and exhaustion at the lows, fundamental catalyst of crisis mode coming in, dollar domination on a global scale with active rate hike cycles and so forth. You can see months of continued rally with very minimal pullback. Then you do have, as these highs are peaked, almost 4 months of consecutive downside, engulfing some of the bullish price action, looking like sellers and dollar are going to come back into play, and then boom, still leading to another rally. Right? This one here, extended months over months of upside with minimal pullback phases, very minimal pullback phases, until this was also going towards the end of 1998. I also want to look at that as well. This is very interesting as well. Extremely large bullish rally through the entirety of almost like a year and a half, coming towards the end of 1981 to 1982 is where towards the end of the fiscal year, you had that extended pullback phase, then into the new year, continuing the bullish rally and dollar domination, right? This bullish rally extending up extremely high, very minimal pullback phases, all the way until the end of 1999. We're into the new year of 1999. You stabilize and continue bullish through that entire year, right? Coming to look at this current rally. Through the entirety of 2021, through all of 2022, extended huge bullish rally. very minimal pullback phases, very high volatility on the upside as well. Now, as we're coming into 2023, deeper pullback phase that can extend a little bit deeper, but into 2023, if we're not breaking below these price points of interest, not correcting the majority of this upside move, the macro fundamentals not shifting out, we're still very, very bullish on the dollar. The historical repetition is still in line. Understanding dollar's behavior on the higher time frames is still perfectly in line. Understanding market timing of coming towards the end of the fiscal year and holiday season and market psychology is still all very much in line. Again, does this mean we're going to instantly just start jumping into dollar buys right now? No, we could still dig a little bit deeper, stabilize into 2023 before seeing some further upside. In the short term and intraday time frames, we do our market update and scalping session. As long as we don't have any fundamental catalysts to bring back dollar domination, whether it's Jerome Powell, the data, or FOMC in December, then we're still going to be playing dollar weakness, leading to these potential price setups into the new year. Right? Now, this also makes a lot of sense when you're looking at some of the correlations on GBP USD, Euro USD, and so forth. When you're looking at the higher time frame on GU, we had months of continued downside, very minimal pullback phase, and now into the potential new year, we're coming to retest this very key broken level, very similar to how dollars retesting those very key broken highs. Right? As long as we still remain below here, yes, we can dig a little bit deeper, but into 2023, we're still maintaining overall bearish structure, didn't correct this downside move, pull back in correlation to the extended downside, and still coming to retest key price points of interest. Right? Can GU still dig up deeper, going into like potentially 1.24, 1.23 plus? Of course it can. But if we do not break above there, especially into the new year, do not lose sight of the macro market image. Right? Euro USD here, very similar idea, in a pullback phase from lows printed. But again, zoom out. This is towards the end of the fiscal year. A lot of the major fundamentals that led to dollar domination being priced in. Retesting or coming to retest a previous broken support turned into resistance. Finally seeing a large pullback after consecutive months of just straight downside and very minimal pullback phases. Right? Are we still going to be adapting into the next potential month of EU retesting up to like 1.05, 1.06? Sure, but we can't lose sight of this macro market image. So, understanding dollar domination and understanding this chain of events on our currency pairs as well, and even when we come and look at gold in a second, macro dollar domination is still very much active. From a macro technical perspective, from a historical repetition perspective, from the fundamentals of the Fed's rate hike cycle and plan. But market waves are very prominent and very common to reoccur. As we're approaching a key point in market timing of approaching the end of the fiscal year, the market makers, institutions, and politicians still wanting to keep consumer morale high, economic activity high, and investing activity high, preventing any panic selling on the stock market, preventing any crash or continued downside on equities, we can see that these pullback phases are active. But these higher time frame pullbacks are correlated to the extended downside that we've seen on Euro USD, GU, and the upside on dollar. Right? So keep those events in mind. USD CAD is obviously going to be more in the inverse, looking a lot closer to dollar. But USD CAD still above these key price points of interest, even having aggressive pullback phases. Just because we're having a rejection at that same point, it's still just in a higher time frame consolidation and still very macro bullish, right? Understand secondary phases of market structure on the higher time frame. Pullbacks and corrections are very common, especially if you have fundamental catalysts supporting that. The main focus points in this next coming week that obviously I'm going to talk about in the market update webinar and just in the next month is, of course, the Jerome Powell speech, more US economic data, and of course, the December FOMC with focus of December CPI and labor market. We're going to see continued dollar weakness and stock market rally towards and into the end of the year if CPI is still neutral and improved, labor market is still weak, and the stock market, and the Federal Reserve doesn't bring any new hawkish events that have not been priced in or aggressively killing pivot prayers, taking away from stock market gains, right? But seeing this pullback phase in the dollar, understanding that historical repetition, understanding the behavior of this currency and the real world implications of its upside volatility is perfectly understandable and normal, very well in line with the higher time frame. Same thing with Euro USD, same thing with GBP USD, same thing with UCAD in the inverse. Now, US 30 is almost back to its all-time highs. What we had take place is the bear market we played very well. We played this bearish corrective market, which we know it's a lot slower, a lot more stagnant for stock market bears versus bulls. As we failed to break below that key price point of interest, which was pre-pandemic highs and that pre-COVID point, we also had fundamental catalysts of bad unemployment rate, feeding into Fed pivot prayers, improved inflation report, and then neutral to dovish Fed speakers, not bringing any more hawkish remarks, which is obviously going to be adding into the basket of reasons for the stock market greedy buyers to continue their rally. This can still easily extend towards back into the previous all-time highs going into 35K, but it can still just be a price point of interest into the new year for stock market buyers in whales to offload from extremely favorable price points of interest if we don't have a fundamental shift in the Federal Reserve's rate hike cycle. And as I discussed in previous webinars, this one improved inflation report is not enough to completely shift the Fed rate hike cycle. Having the market makers, politicians, institutions, and corporations push some spending through the holidays, continue to keep consumer morale and activity high, continuing to keep investment activity high. All this is going to do when we come to 2023, January and February CPI reports is still have those inflation reports very high, right? Showing that the Feds will just come right back to the table saying, well, we can't slow down anymore. We got to bring down this high risk inflation. We saw a surge after the holiday season. That one-off inflation report was not enough, and we have to go back into our expectations, almost creating more of a macro double top on equities here that can form with not having any more validation to break out of the all-time highs, right? But as long as Jerome Powell doesn't bring any new hawkish remarks, as long as we still have this sentiment continue into the holiday season, the stock market could easily dig into 35K before seeing more signs of rejection. On the intraday timeframes, we still want to play some of this stock market upside. We still want to play some of the dollar weakness to better buy zones. We still want to play the bullish pullbacks on GU and Euro USD and bullish pullbacks on gold. Now, when we're coming to look at gold here in the higher time frames, very similar idea. All we have really done is break below a double top neckline in key price sensitivity area after having months and months of consecutive downside, right? Gold can easily still dig into like the 1800s, even into the new month, setting up order flow for 2023 and still end up turning bearish. Remember, it's a lot easier for risk assets to be bullish than it is to be bearish for the real world economic implications that these asset class values have. You can see, even though we played consecutive months of gold bears and dollar domination, every single month had aggressive wicks, not the largest bodies. And you can see this 1 month of optimism and upside, huge bullish engulfing candle. But it's still in relation to this aggressive downside move we've seen and understanding order flow of higher time frame market structure. Does this mean we're just going to be jumping back into higher time frame gold sells right away? No. Gold on the intraday time frame still has potential to dig into the 1800s, still have buyers squeeze out what they can towards the end of the fiscal year, and give better positions into 2023 for whales to offload and liquidate out of the market, and also enter short sells from very better price points, leading into continued downside through the remainder of 2023, as long as the Feds don't shift out of their macro policy. And in 2023, the inflation readings from the US are still going to be high post-holiday seasonal surge, right? But seeing this pullback phase in relation to this months and months of downside that we got very accustomed to is not out of the ordinary, with all the signs of exhaustion from the lows, and then having bad unemployment rate feeding into pivot prayers, improved inflation report, and neutral Fed speakers, as well as coming into the market timing of the end of the fiscal year, right? Remember, historical repetition is never going to be exactly the same one-to-one to previous times in history, as obviously market volumes and liquidity is a lot different, the fundamental catalysts are different, and there's just a difference in the overall economic and market environment, right? But we're still maintaining our macro analysis. We're just in a larger secondary phase of market structure in pullbacks that we've been adaptive to and playing very well. We've been playing the gold upside from 1680s up. We've been playing the stock market upside from 33K up. We've been playing dollar weakness below. We've been playing the dollar weakness on the intraday timeframes ever since the improved inflation report and breaking below 1095. In the short term, we're still going to be playing some dollar weakness, still going to be playing some gold upside, still going to be playing some stock market upside, Euro USD and GU upside, but we cannot lose sight of this macro image, our macro bias, which is still going to be very much valid into 2023, understanding market timing, overall macro order flow, and how these chains of events occur, right? Last but not least, GJ. I don't really have much to say about GJ on the higher time frames. Still very much in line with our historical repetition. Bank of Japan still dovish. Bank of England still hawkish. Very nice bullish market structure. Very nice liquidity zones and collection of order flow. Very nice bullish engulfing monthly candle. This one closing weaker. Still potential to revisit these highs and continue higher into the new fiscal year. Still continuing the historical repetition, still playing the rate differential between Bank of Japan and Bank of England. And if you want more detailed information, just watch previous higher time frame webinars, whether in the private channel or on YouTube, where the GJ higher time frame analysis is still perfectly the same and valid. I just want to talk about these secondary phases when we're looking at dollar relating to some of these historical runs, understanding the behavior of dollar upside, understanding the real world implications dollar upside has on emerging countries, other currency values, and how the economic and market fundamental situation is different from 2008 or the year 2000 and so forth. Is dollar domination from a macro perspective over? By no means at all, it's not. But can we still have deeper downside plays on dollar to 101, 102 flat? Yes. Can the US stock market still go to 35K? Yes. Can Euro USD have deeper pullback phases to 1.06? Yes. Can GU still have some deeper pullback phases to 1.228, 1.25? Yes. Can gold still have deeper pullback phases to the 1800s? Yes. And that's what we're going to be playing in the short term being the next potential days and weeks until we get fundamental confirms of jumping back into the macro information advantage, which is either going to be one, getting consecutive reports of still high inflation readings and labor market still being relatively robust, or two, very hawkish FOMC or Jerome Powell Fed speech. Okay. Make sure you watch previous higher time frame analysis webinars to reference as we've been tracking these trading instruments, asset classes, real world economies, and fundamental events for the last few years.